Why do billions of working people across the globe toil their whole lives yet barely get by? Meanwhile, a tiny group of people can multiply their wealth without grueling manual labor simply by holding assets, data, and resources. The real wealth gap never stems from how hard you work. It all boils down to which production factors you own. Today, we'll draw on orthodox political economic theories and official OECD global data to fully unpack the income gaps between the 7 production factors and debunk all the widespread misconceptions circulating online. Most people get one critical point wrong. Wealth distribution does not reward effort, but ownership of production factors. Simply put, every factory, private firm, and cooperative worldwide relies on 7 core factors to create value. The average person only earns money through labor alone, with a rigid ceiling on their income. Business owners and wealthy individuals, by contrast, generate compound returns from capital, land, data, and more. This video will break down the income logic of every factor once and for all, helping you grasp the truth behind global wealth polarization. Here's the key takeaway. Per core Marxist political economic theories and the Universal Global Economic Framework, wealth creation relies on 7 production factors: labor, capital, land, technology, knowledge, management, and data. Let's use a standard manufacturing factory as our universal example. Workers supply labor, business owners inject capital, production relies on land, technology boosts output efficiency, knowledge optimizes manufacturing processes, management coordinates daily operations, data matches supply and demand to refine production capacity. Each factor follows entirely separate income rules. First, labor the sole income source for most people. Many mistakenly believe their wages equal distribution according to work, and this is the biggest mainstream fallacy online. Simply put, wages in market-driven private firms are merely compensation for labor power, not genuine distribution according to work. As outlined in the Critique of the Gotha program, distribution according to work only applies under strict, specific conditions: public ownership of the means of production, elimination of exploitation through capital, and shared ownership of labor outcomes among workers. OECD global statistics back this up. Annual growth in labor income has consistently lagged behind returns on capital worldwide. Labor generates linear income, you only get paid for each hour you work, and earnings stop once labor halts, with zero compound growth potential. This explains why even the hardest working employees around the world struggle to move up social classes. Relying solely on labor locks you into a low-income ceiling. Next, the 2 traditional core factors: capital and land. Capital covers all productive assets, including factories, equipment, cash, and raw materials, with income built on compound appreciation. The average annual global return on capital holds steady at 4% to 5%, far outpacing the 1% to 2% average growth rate of the world economy. Land encompasses all natural resources and production sites. Its scarcity and irreplaceability deliver stable, rising long-term returns, forming the core wealth base for asset holders and business owners. Then we move to 3 advanced factors: technology, knowledge, and management. Basic manual labor delivers the lowest pay, while technology, knowledge, and management represent complex labor that drastically lifts production efficiency and creates excess value. This explains why senior technicians, managers, and professional specialists earn far more than assembly line workers. The major advantage of these factors is their accumulative, iterative nature. Earnings rise steadily as expertise and experience grow. The final core emerging factor of the digital age is data. Most people overlook its immense value, as data differs fundamentally from traditional factors. It is non-competitive, infinitely reusable, and cheap to replicate. Simply put, production and supply-demand data collected once by a factory can be reused endlessly to cut costs and generate extra revenue. This is why digital platforms and data-driven factories outperform traditional physical businesses in profit. Data creates multiplicative wealth growth. If you want to figure out which factor fuels your primary income and how you can lift your income ceiling, like and save this video, and comment below to share your main source of earnings. Here's another vital point. Almost no creator online explains fully the complete three-stage distribution cycle. First is primary distribution, a market-based system that allocates revenue based on each factor's contribution. This covers factory salaries, capital dividends, and land rent. Second is redistribution, implemented through national taxation, social security, and welfare systems, such as the high-tax, high-benefit model in Nordic countries that narrows income gaps between factor holders. Third is tertiary distribution, driven by social charity and mutual aid, embodied by cooperative systems across the globe that share resources fairly. This three-tier system explains why pure market distribution alone widens wealth disparity, while a full distribution framework balances productivity and fairness. Many people misunderstand distribution according to work as a universal solution, but it only functions within systems centered on public ownership and labor, and cannot fully adapt to market economies with multiple coexisting production factors. We'll now dismantle another pervasive online myth. Shared prosperity is not egalitarianism. Egalitarianism erases all differences between production factors, paying everyone identical income regardless of their labor input or asset contributions. This crushes incentives to innovate with technology, capital, and data, ultimately dragging down overall productivity. True fairness means distributing rewards reasonably based on each factor's contribution, guaranteeing basic living wages for laborers while encouraging innovation across all production factors to shrink unreasonable wealth gaps. We can see this clearly by comparing economic models globally. Western private systems prioritize efficiency for capital and data owners, but widen wealth divides. Nordic welfare states use redistribution to strike a balance between fairness and productivity. Global collective cooperatives adjust the split of earnings between labor and other factors to protect ordinary workers' interests. No single economic model is perfect, yet the core rule remains unchanged. Production factors determine your income, and distribution mechanisms determine how fair that income split is. To wrap up, we can rank the 7 production factors by income potential. Data, capital, and land deliver compound, exponential growth with the highest income ceilings. Technology, knowledge, and management offer steady, rising returns as skills advance. Ordinary labor alone generates linear income with a strict upper limit. If regular workers hope to break free from income limits, blindly working overtime is not the answer. You need to stack multiple production factors, shifting from single labor income to multi-source factor earnings. Subscribe to our channel and stay tuned for future deep dives into factor income and core economic rules.